You are listening to Keystone's Stock Talk Show, episode 236.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again this week. Even better to be conducting this episode without Brennan. We have 3 Your Stock Our Take segments, kicking off with Aaron's answering a viewer question on Bird Construction Inc., symbol BDT, a Canadian construction company operating from coast to coast and servicing all of Canadians' major markets. Q3 growth appeared to be strong on both an organic and acquisition basis, and the viewer asks us if this bird is about to fly. I will answer a viewer question on Real Matters Inc., symbol REAL, REAL on the TSX, which provides network management solutions to North American lenders and insurers. Its platform leverages independent field agents to deliver appraisals and title and closing services. The stock, while flat on the year, is down over 80% from its pandemic highs. The viewer asked if we believe it has hit a bottom. And bringing up the rear is Brett. He answers a viewer question on Goodfellow Inc., symbol GDI on the TSX, a diversified manufacturer of value-added lumber products, as well as wholesale distributor of building products and floor coverings. The stock is up 9% year to date, and at $7.15 with a market cap of $121 million, it pays a strong dividend yield of 7%. Brett will let you know if this historically cyclical business offers value in its current range. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, and one part of the Killer Bees, Brett. Brennan, of course, he is on a travel day today, and as he returns from watching football, hockey, and his friends making fools of themselves in front of thousands of women, undoubtedly in Vegas, we'll get an update directly from their young man on his endeavors down there over next week, but we look forward to that. Do you guys think he's still alive? We got one picture from him. We've seen one picture. That's all we've seen. Do you think he's still, is there a heart beating still down there?
Well, barely. Yeah, barely. Yeah. Alive. Broke.
I'd say.
Stranded.
He probably won't even make. He's got a buffer day in between, so
he's
and
coming
then he
back
can bring
today,
it back
right?
to the office. Yeah, he's coming back
So
today.
We won't see him.
We won't see him till
Or he was
Wednesday,
supposed to come back today,
I think, or Tuesday. I don't know when we see him. When is he in the office?
soon.
Brett might know.
Wednesday.
Nobody knows. That's it. So he's got a buffer day in between. So he should roll in, we'd think. All right. Well, we've got 3 Your Stock Our Takes. You got nothing else to say, you two?
Yeah, I have something else to say. I'm still waiting for my Keystone mug.
Yeah,
we're thinking about getting a Keystone.
That's one
mug.
thing. We're looking into
Talk
some
on the
swag. We'll
podcast
have some Keystone mugs, and
get
we'll
rid of
give
my
some
giraffe
away.
mug here.
We'll give some away to the best Your Stock Our Take. We'll send those off to people. So just to let you know, that's what's coming. Mugs and nothing else. That's it.
Well,
Just
you know
mugs.
what is coming up? Don't you guys have a talk coming up?
Thank you.
Yeah, that's right.
Yeah, tomorrow, and you can find this. We'll send this out with the podcast email. Aaron is going to be speaking at the MoneyShow. Do you know the times there, Aaron? Do you have a clue? Sometime midday tomorrow, Aaron will be speaking, and it might be today. It's on Tuesday, the 28th. Tuesday, the 28th, Aaron will be talking. On Wednesday, the 29th, I'll be talking. Go to the MoneyShow website, or we'll send out in this email. You can sign up to view that, the email that comes out with this podcast. You can sign up to view those presentations. We'll both be doing 30-minute presentations. So talk about our services, talk about a few stocks we like right now as well. So I encourage you, listen to those 2 presentations through the MoneyShow. You can get the link to those presentations in the link that goes out with this podcast, or the email that goes out with this podcast.
It'll be in the description as well.
It'll be in the description. If you're watching this on YouTube right now, go below and you can click on that and sign up, watch those 2 presentations, because you want to see more of our faces, I'm sure. And we'll have, we'll have some good content there.
My talk is going to be, they have me down here for 3:55 Eastern time, so 12:55 Pacific. And the title of my presentation is going to be Smart Investing Simplified, combining individual stocks and index ETFs for profit and protection. So definitely tune into that.
And I'll be on Wednesday. I'll talk about current market valuations, how there appears to be a mispricing of small to mid cap companies versus kind of the magnificent 7 and some of the large caps. So there's an opportunity there, and I'll give you a couple stocks that you can look at to potentially add to your portfolio today. So take those in, and thank God Brett remembered that, because we were just going to go on to our Your Stock, Our Takes. But now we're going to answer some viewer questions. So Aaron, you had a question come in on the bird. Bird is the word?
Bird is the word. Haven't heard that for a while. Yeah, that's right. So Bird Construction is the company that I'm going to talk to about here.
See, I think of Peter Griffin.
Actually, we followed this. I believe we actually had coverage on this company years ago. So it was a bit of a trade, because we found that there is a lot of volatility in the financial performance at the time. But let's see if anything's changed, because this would have been over 10 years ago that we had coverage on it. So Bird Construction, symbol is BDT on the TSX exchange, trades at just under $12 per share. It's a $640 million market cap company, and it pays a dividend yield right now of 3.6%. So what they're a leading Canadian construction company. They operate coast to coast. They provide a range of services, from new construction for industrial infrastructure and institutional markets to industrial maintenance, repair, and operations. And this includes mining. They're in nuclear space, so power generation. So diversified construction company across Canada. And if we look at the share price performance over the past 12 months here, we can see they've had a very nice run. A year ago, they were trading at about $7.25 per share, and trading now for $11.90. Now, when we extend this back to a long-term stock chart, we can see that it's been a very wild ride for any investors that have been with this company for a significant period of time. So looking back over the last 15 years, the stock hasn't really gone anywhere except for up and down. So it's been very highly volatile. So what has been happening over the last 12 months? And is there something changing with the company that is going to encourage more growth or more sustainable growth in the future? Let's take a look at the Q3 results. So revenue was $783 million, up 17%. Adjusted EBITDA just under $50 million, up 58%. Margins increased in the quarter, so EBITDA margin of 6.3% compared to 4.7%. And then adjusted EPS of 54 cents, up 86% year over year. And then for the year-to-date numbers, also very impressive. So revenue was just over $2 billion, an increase of nearly 17%. Adjusted EBITDA, $95 million, up 35%. EBITDA margin of 4.7%, up from 4.1%. And then adjusted EPS of 93 cents, an increase of 63% year over year. And when we look at the management commentary in terms of what was driving this strong performance, revenue growth was primarily organic, but there was also some contributions from recent acquisitions. With respect to margin expansion, they focused on effective cost management and operational efficiency. They talked about strategic repositioning that they've been focused on over the past couple of years. And what this means is shifting into more attractive markets, including the institutional building sector, infrastructure, and industrial construction and services, most notably mining and Canada's nuclear sector. They also have a growing backlog, up 20% year to date, and they've talked about significant multi-year recurring revenue coming from the master service agreements, which they've signed recently. In terms of outlook going into next year, they're expecting a strong finish to 2023 and potentially even a stronger showing in 2024. So in terms of the outlook, the management commentary, all of that looks very strong. Now, there have been some recent announcements from the company that look very interesting. They've signed a couple master service agreements. In September, they issued a press release regarding industrial recurring master service agreements in Ontario and Alberta. More recently, in November, they talked about growing their institutional nuclear portfolio in Ontario. So some interesting things coming with the company. And one of the things that I'm picking up from reading what management has to say and just their general commentary is that with these master service agreements, they're able to produce more visible, more stable, even recurring revenues going forward. Now, recurring revenues can be defined as many different things. Typically, when I think of recurring revenues, I think of subscription, software subscriptions. That's typically the most common form of recurring revenue. And of course, it's always good to have visibility in terms of what the revenues are going to be 1, 2, 3 years in the future, as opposed to highly contract-based businesses where, they may sign a couple of really big contracts one year, they finish those contracts, they sign a lower number next year. And you always have these major shifts up and down in revenues and then earnings. So this is something to really pay close attention to, because it does, when we talk about their strategic repositioning and then some of these master service agreements that they've been signing, and certainly in some interesting spaces. I mean, nuclear is all the rage right now. But they say that they have an opportunity to bid on over $1 billion worth of environmental remediation work through their master service agreement in Ontario. So this is something that we want to learn a little bit more about going forward. But when we look at the historical performance of the company, you can see what I mean in terms of how volatile it's been. I mean, gross margins have really moved up and down. Historically, they're right now pretty much at a historical high with gross profit margins of about 8.5%. But they fluctuated a lot. They were as low as 4.2% in 2018. We've seen some up and down, and we've seen the same thing, which would be expected, of course, with earnings per share. Growth declines, more growth, and then potentially in the future more declines. Even a year of negative earnings in 2018, although most of these years have been positive. So one thing that I will point out, a gross margin of 8.5%, even though that's a historical high for the company, that is an extremely low gross margin. This is typical, I think, of construction companies, just because there's a lot of overhead. So it's more of a high volume, high revenue, lower margin business. And they are certainly driving significant earnings per share to the bottom line. So that's a positive. But this is a low margin business, and that's something that needs to be considered. In terms of the balance sheet, healthy balance sheet, cash of $104 million, debt of $87 million, shareholders' equity of $304 million. So they have net cash of about $17 million. Not a huge net cash balance, but it's still a net cash balance. And then debt to equity of about 0.34. So very reasonable debt to equity level there. And then in terms of valuation and future growth, just looking at some of the analyst consensus estimates out there, analysts are looking at about $1.32 in the current year, $1.53 next year. So that would be current year growth of 53%, approximately at the midpoint of analyst estimates for this year, and then 16% next year, and price to earnings multiples of 9 times current year's expected earnings and 8 times next year's expected earnings. So certainly a lower price to earnings multiple, which we would expect. I mean, Bird is always generally traded at a fairly low multiple. I'd have to look at the historical range. But it's given that it is a low margin business, it has a history of being quite cyclical, we would expect to see a lower multiple. So in terms of our take, on the positive side, the performance recently has been very strong. We've seen the increase in margins, a growing backlog, a healthy balance sheet. Management's positive about the outlook. The valuation looks reasonably attractive. And then what's really interesting to me is learning more about these MSAs and how they may increase the long-term recurring revenue and maybe put Bird in a position where their margins and their revenue growth is a little more stable than what we've seen in the past. On the other side of the equation, on the more negative side, it's a very low margin business. They do have that historic track record of being very volatile margins, volatile earnings, and uncertain sustainability of growth. So it looks like we're going to see the company produce very strong growth this year. Likely they're going to produce a strong year next year. But what happens after 2024? Generally, we like to invest in companies where we have, some sense of where the revenues and the earnings per share are trending over a multi-year period. But if they're signing a lot of contracts right now and then these contracts expire, or they complete those contracts and they're not able to sign new ones of the same size, we may see continued volatility in the future in financial performance. So that's something to pay close attention to. And then, of course, even though we're looking at a valuation which is below the market average of 8-9 times earnings, this stock does tend to trade at a lower valuation multiple. So we have to factor that in as well. However, looking at the company, we think that the fundamentals are quite positive. The strategic repositioning is interesting and may result in better future performance. And we do think that it's worth taking a deeper look into Bird Construction and potentially organizing a call with management so that we can ask them some questions. So this is basically, what I've shown. It's the first stage of the research process. This is just really, does it pass the initial criteria? Is the financial performance strong? Are there reasons that to believe that this strength in the financial performance can continue? The valuation, the balance sheet. This is when you do that financial statement analysis. And then the next stage is to really dig deeper into what's going on with the business and these contracts and the market to determine how sustainable this performance is going forward. So I think that Bird certainly passed our initial screening criteria. And then the next step would be to just to dig deeper.
Yeah, it's a good summary. We actually, I think Brennan pulled them out in a recent sweep we did when we looked at all Canadian companies, and he pulled them out as interesting and one we might want to, go and interview management. And historically too, I don't have a historical 10-year PE, but on an EV to EBITDA basis, I think the average over the past 10 years is 9.61, and current EV to EBITDA on Bird is 5.8. So it's lower, significantly lower than its 10-year average. Although, like Aaron said, the business has been cyclical over time. So, there is some.
But that's a good sign, right? Because if it's the market is known that volatility has existed. So if it's trading at a discount now to where it's been in the past, in spite of there possibly being some good arguments that performance will be more stable and better in the future, then that's a good sign. Now, one thing I would also,
or is the market saying we think it won't be? That's the thing. Or does the market not know? The market doesn't always get it right in the short term.
You have the average, but what's the variance there as well, right? I mean, if it fluctuates between 3 times and 10 times EBITDA, that's also important to understand. So. But certainly worth a closer look. Yeah,
for sure. And I think we will reach out to management and have a call with them, and then we'll see if we can get anything more from them that really confirms whether or not we think this is a more sustainable, growth trajectory for the business going forward. Because it certainly is trading at relatively low valuations. And Aaron did a good job of summarizing that. Now I'm going to look at Real Matters. Real Matters. REAL, very simple, on the TSX, trades at about $5.35, $390 million market cap. So it's a small cap in Canada. Real Matters, the company provides network management solutions to North American lenders and insurers. Its platform leverages independent field agents to deliver appraisals and title and closing services. The stock, it's been flat relative for the year, but it has lost 84% of its value post-pandemic from highs in the $33 range. The Q4 results, its fiscal year 2023 results as well. Net revenues dropped 22% to $11.2 million from $14.4, and for the year dropped 50% to $43 million from $85.4 million. Adjusted EBITDA was positive at $600,000 for the quarter. from a loss of 1.1 million in the same period last year, Q4 2022. The company reported net income of 1 cent on an adjusted basis for the Q4 and a loss of 3 cents on an adjusted basis for the year. On a positive note, Real does have a good balance sheet and exited Q4 of its fiscal year with a net cash position of 42.3 million. That's about 80 cents per share. The valuations, well, on a forward-looking EV to EBITDA basis, the company is essentially trading around 50 times EV to EBITDA. Now, this would be based on some optimistic estimates that I saw out there. Our take, Real Matters, is operating in a difficult environment at present. Over the company's recently reported fiscal 2023, U.S. mortgage origination volumes were the lowest on record in the last 28 years. Mortgage applications, for example, in October 2023, were the lowest since May 1995. It's estimated that for the first 3 quarters this year, 2023, mortgage originations in the U.S. were down about 30% relative to the same period a year ago. Suffice it to say, this is not good for Real's current business. Real posted a tremendous growth trajectory from 2014 when its revenues were about 128.1 million to 2021 when they peaked at 638.6 million. This was during historically low rate environment. As rates have risen, consolidated revenues have dropped from that $638 million peak in 2021 to 222.6 million in fiscal year 2023 just reported. While market volumes appear to be closing in on a trough, we do not have visibility on a sustained shift in the macro backdrop whereby interest rates fall and mortgage spreads begin to normalize. Current valuations are not cheap and appear to imply that a midterm recovery is already priced into the stock. Whether it has hit rock bottom or not, it's tough to estimate. What we do know is that there are plenty more companies in our coverage at present with lower valuations and better near-term to mid-term growth certainty than Real. We would pass on this company at present. That's all I got on that.
Yeah, and so this is the situation where, you know, when you're looking at a company that is in decline, like maybe a short-term decline, you want to be compensated for that extra risk by being able to pay a lower valuation. I mean, that's where your margin of safety is. So when you're, you know, the company is seeing challenging financial times, but it's still trading at a big premium, and that's not a combination that.
No, and it offers residential mortgage appraisals for purchase and refinance. And in some of the refinance areas in the U.S., you haven't had to do some of the home inspections and the title searches that you had in the past. So they've kind of eased those regulations. There is not only a general macro downturn that they're facing, but there are some regulatory changes that have hit the company as well, as far as I understand. So, you know, on a forward-looking basis, even based on, you know, relatively optimistic estimates for them to have somewhat of a recovery in the second half of next year, it's still trading at 15 times EV, or 50 times EV to EBITDA off those estimates. I don't think that, you know, you're being compensated for the risk that is in here right now. And I think that, you know, I think that this company is relatively well run. They have a good balance sheet, but there are, like we said, your capital is always fighting for a place to go to. If we can see another business that trades at low valuations that has growth ahead of it that we can forecast with a higher degree of certainty, there's less certainty here, we'll put our dollars there. And not that this is the worst company on the planet or anything like that. It's just not where we would be putting our dollars right now with any certainty.
They actually have a really good chart in their MD&A for really showing the macro situation in the U.S. housing market, which I'll put up on screen.
Yeah,
and you
excellent.
can see in that 2020, 2021 era during the COVID years when we had super low interest rates. And if you're a Canadian listening to this, the U.S. standard mortgage is a 30-year fixed mortgage. So unlike ours, where it's normally a 5-year, even the average is less now, fixed rate, and then you'll have a 30-year amortization. Theirs is fixed the entire time. So you can see the U.S. really refinanced. So you had all these refinancing originations. during that super low interest rate because everyone wants to lock in that 1.5%, 2%.
Incredible boom for business for them.
Exactly. Yeah. And now you've seen that just drop off. So you can see in this graph that the refinancings effectively have disappeared because you haven't seen these interest rates in 20 years.
Yeah. Who wants to refinance right now?
Exactly.
It's the environment right now is not good for the business. So we'll not be putting our dollars at present towards real. We'll watch the company. There's likely a time when that switches and there could be an investment opportunity, but it's certainly not at this price. And based on forward estimates, near term, it doesn't meet our criteria. All right. We're going to switch off to Brett. He's going to share his screen and he's going to talk about Goodfellow.
Yeah. All right. So Goodfellow, symbol GDL on the TSX, is a diversified manufacturer of value-added lumber products as well. It is a wholesaler of building materials and floor coverings. Goodfellow has a distribution footprint from coast to coast in Canada, servicing commercial and residential sectors through lumberyard retailer networks, manufacturers, industrial infrastructure project partners, and floor covering specialists. Goodfellow also leverages its value-added product capabilities to serve lumber markets internationally. The stock is trading up 9% year-to-date at the current value of $7.15 a share at a market cap of $121 million, paying a strong dividend yield of 7%. For fiscal Q3 2023, the company's sales fell by 17%, however, to $139 million. And for the year-to-date, sales fell 19.6% to $387 million. This really illustrates the shift in the lumber demand over the past year, as the post-COVID boom saw significant demand surge, resulting in many, many purchasers just overstocking on their inventory. And now that we are seeing more normalized demand, they have to work off this excess inventory before ultimately purchasing more lumber from Goodfellow, so it impacts their sales. Gross margin has remained relatively constant, though. It's at 22.7% for the quarter compared to 22.6% in the prior year, resulting, however, since the sales dropped, in a gross profit falling by 16.5% to $31.6 million. As well, SG&A remained materially flat. So as gross profit fell, we can see the negative side of having a heavily operationally leveraged company. In any distribution, you really see this, resulting in a significant decrease year over year for net income to only $6.2 million, down from $10.6 million or 72 cents from $1.24 on a per share basis. As well, the year-to-date EPS fell by even more, by 55.4% to $1.47 from $3.30 a share. As well, due to the construction seasonality, Goodfellow is as well seasonal. So Q2, Q3 are normally the strong quarters, so we've really seen the year play out. Before the fourth quarter, you'll normally see quite a bit lower, and we'll actually see that in a couple slides coming up. So we can look at the 20-year quarterly earnings chart. We can see that EPS in recent years has just been significantly higher than historic norms. We can see the previous 20 years, it's roughly hitting the same levels for both EPS and sales. But then in that 2020, 2021, and a bit into 2022, the sales were just dramatically higher, which led to higher EPS. But you can also see that the percentage change in sales isn't very significant year over year or even quarter over quarter. But then it really trickles down into that EPS. So that change in sales just ultimately becomes the change in EPS. But when you're looking at the earnings per share versus the revenue per share, those small changes add up a lot quicker. As well, you can notice in this long-term graph that besides that 2020, 2021 period, they had really no growth the entire time. So moving to the balance sheet quickly, the company holds cash of $8 million, with the only debt being leases of $13.7 million, resulting in a net debt and leases of $5.8 million. This is after they have paid off bank debt of $31.6 million over the past year, which is good to see. With distributors in really any business, margins are so small that it can just quickly eat away at any profitability, especially with interest rates being where they are. As well, added on top, they are cyclical. So if you have a downswing with rising interest rates, it can just completely deteriorate the company's performance. And it's good to see that they got the debt off their balance sheet. Now, switching to valuations. Goodfellow is trading at a trailing PE of 7 times, which is well below their 10-year average of 10 times, which may just seem appealing as the company is below that average. However, you do need to remember if lumber demand specifically related to like single family homes, which they're called out in their MD&A, if that continues to decrease, you could see further earnings decline, which would ultimately result in a higher PE trending towards or perhaps even above that average. So even though it does appear low, it may not be when you're looking forward. However, you probably aren't really looking at Goodfellow at the time for capital returns, given its historic price performance. You are probably looking at that 7% yield. The company at its current earnings has good dividend coverage, about 50% in their earnings over the past year, but that can quickly change due to what I've mentioned above. We can see with their historic dividend payments that they're not consistent at all. They'll continuously raise and cut as they see fit, as well as they at times it will issue special dividends during certain uprises and quarters, as well as only a semi-annual dividend normally. And then they also occasionally do special dividends. But you can see in 2018, during that period when the demand or their earnings were very low, they cut their dividend completely. And now we're really at an all-time high dividend. But that being said, they just this last quarter declared another 50-cent dividend, so they haven't cut it yet or decreased it yet. But that is something you would need to watch going forward, especially given their history. So our take, although the company does appear cheap with a high yield, the dividend really isn't safe by any means, given their historic tendency and the earnings cyclicality. The valuation will likely come up as well if earnings were to drop, and that does seem to be where we're heading towards, given the industry. They're really, and the end result of their industry, they can't really do too much to really move that lever. So they really have to take what the industry gives them, and it's a cyclical and seasonal industry. As well, you cannot really expect growth from the company given its historic growth, but I will say their balance sheet's a lot better, so perhaps they could acquire something. And if there was a substantial decrease, you would see some cheap valuations for acquisition targets, and they could take on some debt at that time to produce non-organic growth, but I wouldn't be counting on that organic growth. So overall, I would just really pass on the company for now. There just isn't really a point to put your money in with the risks at hand. As well, given you would most likely be a dividend investor for this company, and the dividend is not really secure given its historic tendencies. So open up to you guys.
Yeah, I think that you summed that up perfectly. Really, it's you're investing in the company really for the dividend income, but the dividend income is not. I mean, that dividend can be cut quite quickly, and that seems to be the somewhat the expectation, or should be based on the historic performance of the company, right? So yeah, right now they have good coverage, but earnings were down 50%. I mean, with that type of volatility in earnings, you don't know what the coverage is going to be starting next quarter.
Yeah, and the lack of growth you point out there. I mean, they had a huge uptick in earnings per share essentially, but the revenue profile didn't really increase well above their historic peak their peak multiple that they hit, or their peak figures that they were hitting essentially. So really it's for me, it may look like a bit of a value trap if you're looking at where they are right now. And if earnings come down, then suddenly you don't even support the current price. It's up year to date this year with declining earnings, which is strange in this market. I know they've done a great job paying off debt. I mean, that's something that's, likely high price debt or probably variable debt, which is a good thing in this market. Maybe like Brett said, maybe there is an avenue to make acquisitions, but it doesn't look like a lot of organic growth, which is the growth that we would prefer to at least have in a business. And the valuations probably get more expensive as their earnings decline over the course of this year. Plus, they're facing an uncertain market. So I'd kind of watch out near term or midterm with Goodfellow. All right. I think that's going to close off the show this week. Keep your questions coming in for your Stock Our Take segment. Also, again, if you want to watch those presentations, the Money Show, you can just, if you got this via email, you'll have a link in the email to get to those presentations. Sign up to watch those, myself and Aaron. Aaron's on Tuesday, the 28th. Mine is on Wednesday, the 29th. And you'll also, if you're viewing this on YouTube, you can just see in the below the video, you can see essentially it's the link should be there. All right. Keep those questions coming in, and your stock car take, smash that subscribe button. And if you're viewing this on iTunes, only give us positive reviews. That's what we're looking for. As always, profitable investing. I wish you. Thank you.
Thank you.
Thank you.